And time to talk the economy and much more with our friend Jeremy Siegel, professor emeritus here at the Wharton School and a senior economist at Wisdom Tree. Jeremy, how are you today, sir?
I'm doing well, Dan. Thank you.
Thank you. All right. So we're coming out of a Fed meeting where we got a 25 basis point cut. I don't think anybody is surprised at that, but give us your thoughts on what maybe we're looking at moving forward, because it seems a lot of the conversation is more cuts to come.
Yeah, it was an interesting meeting. From everyone knew it was going to be 25, as you said. I found a couple things interesting. I found uh, uh, it was interesting that Chris Waller only voted for 25, did not dissent for 50, which I thought was interesting since he was one of the leading candidates for new Fed chair, and obviously Trump wants more than 25. I also thought it was interesting that Kevin Hassett, also brooded as one of the top candidates, said, oh, he's all right with 25. Of course, he's not on the Fed right now, but um, we all expected Steve Mayron to go for 50, which he did. But the rest was a big support, I think, for Chair Powell. I mean, they all, I thought there was going to be dissents on both sides. Also, I thought it was interesting that uh, although the median cut was two more cuts, almost half say, I don't want any more cuts. And then about half said, yeah, I'll go one cut each of the next two meetings. So there's still a lot of division there on the Fed. I mean, my feeling is they should be cutting. I've made that point, that I believe that the Fed funds rate should be in the low threes, given that the 10-year is in the low fours, and that there should be a gap between the two. But, clearly the data has held up strong. I can understand the division at the Fed.
Could you make a case for a 50 basis point cut this most recent meeting, Jeremy?
I mean, I could make that case for a 50 basis point cut because, I think the Fed usually moves too slow. I've written on the fact that in the past, the Fed used to move much more up and down. It wasn't viewed as if you start moving up, you've got to keep on moving up, or start moving down, you keep on moving down. They look at the data every time. Um, Employment growth has really weakened. Certainly, inflation has not, but there are two very important factors. One, housing is definitely not showing the increases either at the rent or the price, big part of the CPI. And also the tariffs, which I do not believe should be a reason for raising rates to the extent that they go in, because they're really a tax. So for that reason, I don't know if I were on the board, I would have joined Murren on the dissent, but I certainly would have voiced some support for that position.
But that being said, and as we're taping this interview on a Tuesday, it'll run on a Friday. We will have PCE data. We will have more weekly claims data. Then you go out a week, you're going to have another jobs report coming our way. So there is a lot of data that we're looking at in the next, 10 days to 2 weeks that may be able to kind of guide us as to what we're going to see play out here.
Yeah, most certainly. By the way, I think the Friday report, and again, it might be dangerous for me to say so, before, while people might be listening to it afterwards. But I think that it's going to be quite tame. In fact, there's a possibility the CPI, I mean, the PCE deflator, which is what does come out, might on the overall be a tenth less than what is currently expected, which is 0.3. I think that's going to look good. The jobless claims, which we had that one big, weekly jump, was due to Texas. They claimed there were fraudulent claims from Texas, and we did see the next week it dropped back into the 200 to 240 zone, which is the safe zone, and that is expected also to be on Thursday. Now, when we get to the employment data in the following week, I mean, that's when things really start, getting interesting again. In those, will that tremendous slowdown that we get, will that continue, and will that drive a negative print, which I think is psychologically quite important. But one has to say at this point, spending is holding up. It's not going gangbusters, but it is holding up, and even the high frequency and the anecdotal data suggests that we do have that holding up. Again, if tariffs suddenly hit like a near when people start buying for Christmas and the holidays, and they really see that prices going up, could that turn psychology quickly? A possibility, but clearly we have not seen that yet.
And then you throw in what seemingly is a belief out there that there is some room to run for the economy in terms of growth. The OECD upping its forecast both globally and the U.S. Your friend James Bullard, in an interview on CNBC on Tuesday, seemingly saying the same thing. So there's, while there are still many questions out there, there seems to be some optimism as to where potentially this economy could be headed.
Yeah, well, for months I've been saying the stock market has been going up because for whatever negative effects the tariffs have, and I'm on record saying I don't like these tariffs, AI has a good opportunity to offset them for profit margins for companies. I mean, they can save more, money using AI than they might be losing on the tariff side, and that is why one of the reasons, as well as the tax cut reasons and others, that the stock market is in fact doing so well.
Let me finish up. Speaking of AI, we got the announcement by OpenAI and NVIDIA of their partnership. But have you talk about just the level of investment that is being put in by so many companies in and around AI, and then obviously all of the other areas that could be impacted when you think of energy and supply chain and technology? I mean, we're looking at a very unique time in our history, aren't we?
Yeah, absolutely. I mean, AI is a revolution. There's no sign of any stoppage or slowdown in that spending at all. In fact, as we see, if anything, there's a sign of acceleration in the spending on that. And again, what we want, which has been the only thing that's been slower than expected, is the adoption of AI to actually improve the profits and save on costs by the non-AI firms that could be the real beneficiary ultimately of the AI revolution.
Jeremy, always great to talk with you and get your thoughts. Thank you, sir.
Thank you very much, Ann.
You got it. Jeremy Siegel, Wharton Emeritus Professor of Finance and also Senior Economist at Wisdom Tree.